everyone, and welcome to our monthly roundtable with John in Toronto and Steve in Vancouver. I'm your host, Ernie Desai in Toronto at Move Smartly, and this is the December roundtable. Welcome, John and Steve.
Thanks for having us on. Let's do it. Yeah.
So I understand we are under the gun because somebody has to go Christmas shopping after this or something. So
no,
we're gonna
Christmas is canceled. Bear market.
So someone might have to be looking for bargains. So we are going to move at a quick clip today, but we'll have lots to discuss on our final roundtable of the year. Before we get into it, Steve, John and I recently enjoyed attending your live Loonie Hour broadcast at the Hockey Hall of Fame in Toronto. You had a lot of excited fans. How did you feel about the show?
Oh, it was good. It was a good turnout, and it was good to see you guys there. And I think John had just as many fans there as I did. So a lot of crossover. No, it was awesome
for sure.
Yeah, we appreciated meeting John's fan. They were fans of Move Smartly, and of course, Steve, your show was amazing. So great to be reaching so many people interested in finance and real estate information. So that was fun.
And I think this is like a continuation of it right here, right? I mean, what we're doing here. So hopefully the viewers get some value out of it. We're always trying to sort of be the forefront of just telling people what's happening on the market and letting people make their own decisions. So
yeah, 100%.
Absolutely. And maybe we will do a live joint show in the future. So we will look forward to that as well. All right, so let's start with the basics. The market update, where are things as we head towards the end of the year? John, let's start with the GTA, the Toronto area. You recently tweeted about regions with some notable drops. I thought they corresponded to whatever went up in the COVID pandemic, now coming down very quickly.
Mm-hmm. Yeah, I mean, I basically shared, I think it was like 8 regions or municipalities in the GTA where prices have dipped more than 30%. Most of those were out in the suburbs. I mean, I should have mentioned, I didn't on my tweet, that most of these declines actually have happened like by the summer. You know what I mean? Like these aren't declines that are happening now during the fall market. When we think about like the fall update, at least in Toronto, it's been steady since September. And by that, I mean, like, sales are still low, listings are still low. Prices have largely been flat since I'd say August. Both low rise and condo prices are kind of steady. Inventory isn't surging a lot. It's kind of right around 2.5 months. So it's been stable. I think that obviously the big declines are negative. I think we've talked about in the past episode, most of those happened because people were caught in 2 transactions. Since then, a lot of people aren't buying first or aren't really pressured to sell. So we've seen some stability in prices. And that's kind of how the year has ended. It'll be interesting to see what next year brings.
John, there was a newspaper headline about detached and semi-detached homes being hit the hardest when it comes to these price declines, and other properties like condos holding their value. Just anything that you can comment on or what you've seen.
Yeah, no, 100%. And that's largely because, low-rise homes, especially in the suburbs, are the houses that saw the biggest boom in prices during COVID. Condos didn't quite accelerate as much. Those segments saw the biggest increase, and usually what sees the biggest increase, what rises up the highest usually, falls the most and has the furthest room to fall. And that's why a lot of the areas that I kind of tweeted saw the big declines were largely, those were low rise prices that I actually shared. And a lot of those were in the outer suburbs for the most case.
Okay, interesting. Steve, Vancouver, what is going on there? Is there a lot of change from the November stats, or are you also seeing that plateauing that John's talking about?
I don't know if I'd say it's plateauing. I think you guys went through a larger correction than Vancouver. I definitely agree with John that you're seeing some firmness in like the pricing. Like, we're not seeing like the massive declines. I think we've definitely put in, we've already had a pretty significant sell-off, but I mean, it's not to say there's not more room to go. I just think like nothing moves in a straight line, right? You're not just going to have like peak and then just like straight down, like for the next 18 months, right? Like it's going to go through sort of these gyrations. I think the big thing that's underlying it is really just like there is there's like we've got like, you know, our business here, we've got a whole bunch of buyers that are actively looking, you know, people that need to transact, right? I mean, they've been renting and they're just like, you know what, we're ready. We've got our down payment. We think it's a decent opportunity to step in, and we're going to buy a single family house for the next 10 years to live in. Like, these aren't speculators. Like, they want to transact, and like, there's no product to sell them. So that's been a challenge. And like, again, you know, there's a little bit of product on there. It's a lot of like the crappy stuff that nobody wants. It's kind of been picked over. And then you got a lot of sellers that I think are still out to lunch on their pricing. They're still asking prices that were achievable, you know, back in April or May. And people are saying, well, this doesn't work. And so there's no deal to be had. So I think that's like the big challenge, and it's probably a big reason why, like, if you look at sales volumes, they continue to be horrendous, because you have this gap, which is this basically air pocket between what buyers want to pay and what sellers are asking. And you know, like I said, the people that are selling are either they have a nice home that people actually want and they're pricing it relatively sharp of where it should be, or you get like these estate sales where someone's passed away and like the family is ready, they have to move the house, and so it clears at the market price. And then you've kind of got everybody else, I find, in between, where there's no transaction to be had.
And have you seen prices continue to decline then in Vancouver?
Yeah, but it's just slow grind. Like, it's so indistinguishable from like last month. You can't be like, oh, prices are lower in November than they were in October. Like, it's indistinguishable. Like, I mean, I think the trend is still in place, which is, I think, like, there's still going to be more deals to be had. I think prices continue to sort of squeeze lower. Like, John and I have been talking about this for the last couple of months, right? Like, we were saying that we don't get everything right, but we're like, listen, it's probably going to be a slow grind lower from here. And I think that's really what we're seeing. It's kind of a slow grind. So we had this huge gap down from like February peak price to like in the summer, like there was a big gap down, and now that gap is kind of tightened and you're seeing this sort of slow grind.
All right. Well, picked over bins of Christmas gifts. I hope that's not all you'll find in the bargain bins after this. That sounds pretty dreary. Steve, you've also mentioned that there are financial stress anecdotes, things that you're seeing. At the risk of inviting Schadenfreude, you recently tweeted that the financial stress is not only hitting consumers, but also some agents. So what are you seeing right now?
I mean, John, I'd be curious to hear your thoughts on this too, but like what I'm getting quite a few phone calls around, and these aren't like clients of ours, like we obviously try to educate them as best as we can. We have different maybe philosophies on the market, but getting a lot of calls on investors that bought units, you know, 2 years ago, 5 years ago, 8 years ago. Some of them obviously have done very well from like appreciation perspective, but most, I would say, a lot of investors tend to have floating variable mortgages because they want the liquidity preferences of entering and exiting the market. And so getting the calls where, hey, you know, I have this rental property and, you know, I'm now losing money every month. Before I was making, you know, a couple $100 a month, and now I'm losing $400 a month because my variable rate mortgage has gone up, you know, 400 basis points. Oh, and by the way, you know, the BC government says I'm not allowed to raise rents more than 2% a year. So I'm stuck. What do I do? And there's no way to get rid of the tenant. You can't just kick a tenant out and put a higher paying tenant in. So these investors are actually getting stuck, I think, largely through bad policy. And so now it's a decision of, do I sort of grind it out, or do I just sell this thing? And so I think there's definitely a cohort of people that are opting to sell, but I do think that we're getting some of those calls now. And I think if rates stay near these levels, I think you're going to have a lot more of those calls next year.
John, Steve mentioned also that some agents, especially those in particular sectors, are obviously seeing a huge decline in volume impacting their business. What are you seeing on that front?
Well, I mean, 100%. We're the sector that's getting hammered the first, I'd say. You know, if you think about incomes, real estate is the first sector to get hammered. I mean, sales are down 50%. I mean, that means incomes are down like more than 50% because actually prices are lower, right? So real estate agents are getting hammered right now. And their incomes are down. The challenge too with real estate agents, a lot of them are investors. Like Steve said, some of them have existing properties, probably on variable rates. And, being cash flow negative for all these years may have been a great idea. It's a lot harder now because the negative gap between your carrying costs and your income has increased, and your carrying costs on your mortgage are probably up. So, people are feeling it. And I think a lot of agents are probably going to kind of especially the ones that have bought a lot of pre-con properties. They're gonna have a massive problem, because people are going to start to realize now why buying pre-construction is not an investment, right? It's not like buying a home where, even if the prices dip, you just hold on to it, keep making your mortgage payments, you're fine. Pre-con is all speculation. Like, you're only doing it because you expect the price to go up. If the price goes down, you're kind of screwed, because you have to cover the difference between that loss, right? Whereas if I buy just a home and it drops in value 100 grand, I don't have to cover that difference. I just have to keep making my mortgage payment. Do you understand what I mean? So pre-con is highly, highly speculative. Like, people can lose their life savings, because if you bought 4 pre-cons and they're all down 150 grand below what you paid for them, now you got to come up with 600,000 in cash, assuming you can even close on them, right? So
John, that's because these buyers have entered into contracts to buy at a certain point. When the buildings reach completion, they then have to go out to get a mortgage for that, but the valuations will come in much lower, leaving them.
Especially for people who bought recently, right? If you bought in the past 2 years, like there's no way the price is what you paid for. Like the value is probably below what you paid for it. And you're right. The one challenge is actually getting the mortgage. The other is, if the value is below what you paid for it, you've got to cover the difference between what the bank says it's worth and what you paid for it. And most people don't have hundreds of thousands of dollars in cash kicking around, right? So that's why, pre-con always was speculative. It has paid off so well because prices kept rising, but no one imagined, well, what does it look like if prices aren't rising 10% per year? And I think people are going to start to realize what happens. And I don't think this is going to go away anytime soon, quite frankly. Like, I don't think this is just a 2023 story, because I don't think condo prices are going to be trending up significantly over the next 2 years, which means any completions over the next 2 years are probably going to be impacted.
John, can I chime in there for a second?
Yeah.
I think this is like the big thing that we have to kind of highlight, right? We're like, there's a difference between like real estate investing and real estate investors, and then there's a real estate speculator. So when you lump like the pre-sale people in, like, it's again different. I think what you can tend to get highlighted, I've seen, especially over the last 12, 18, 24 months, right, is like, you look at a pre-sale project and they've got it for sale, and the developer is asking you for 15 to 20% above the resale price, and it closes in 3 years. And you're like,
that's good. In Toronto, it's like over 30% above the resale price.
Right. But it's like, you're basically, the developers charging you the premium, saying, listen, we expect prices to go up 10% per year for the next 3 years. So we're going to charge you the 30% premium. And I think a lot of these buyers are not sophisticated enough. I think they're just walking in to presentation centers unrepresented, or they're going to these rah, pump and dump seminars, and these realtors are selling them this product, and no one's educating that, saying, hey, you're paying $1,600 a square foot, but the market's trading at $1,200 a square foot. And people are just thinking, well, everyone else has made money on pre-sales, it doesn't matter what you buy. And I think we're now going to see a very, very hard lesson. I just think, and again, it's different from like traditional real estate investing. This is not real estate investing, in my opinion. This is speculating.
It's 100% speculating. And listen, it's not like that speculative bet has paid off for many years. You know what I mean? Yeah. But it's in down markets where people are going to start to realize, when the returns are so great, people don't realize, like, there's a reason why these speculative investments have paid off, because the risk is greater, and no one anticipated the risk until this moment. And they're going to start to realize what the downside is of buying multiple pre-cons at 30% plus above resale prices when prices aren't rising rapidly. And I think it's going to be a tough lesson for a lot of people.
And just to chime in there quickly, so not all like pre-sales again are like entirely speculative. Like, we sold pre-sales, there's times where like, it's not something I focus in, But there's times where you can identify a project and say, oh, wow, the developer is offering, a 10% deposit structure and they're selling them at resale prices. It's not done for 3 years. That's probably a pretty good play, especially if you can actually run the numbers and say, even if the market doesn't go up, this thing will break even on cash flow. And you know what I mean? So it's not everyone. And then you've got obviously first-time home buyers that like to sort of save up over 3 years and put a little bit money down. So there's times when pre-sales can be effective. I just think like the market got so far ahead of itself that these people were just like speculating and not running numbers. And like, there's no way you're going to make any money.
But I think 100%, but even if the numbers work, because I had a lot of people reaching out to me, like, I don't know, like a year ago about buying a pre-con low-rise home for themselves, right? And the number's good, the house is great. But at the end of the day, I said to them, you still have to be prepared for this exact risk that we're facing now, that you're going to buy it at peak prices. What if prices dip? And that's who's getting hammered now, because a lot of the low-rise have faster completion cycles. So even though the numbers were good in the moment and they're not investors, they're end users, they're still exposed to that risk if prices dip after they bought, right? And that's not, which is very different from if you bought a home in February and you live in it and you just have to keep making your mortgage payment. Your life savings aren't wiped out. Whereas if you bought pre-con and it dipped 20, 30%, you have a massive check you've got to cut and you got to have that in cash. So it's a lot.
Yeah, and I guess the other thing to add to that too is the, you always, the thing with pre-con is like, yeah, there's lenders that where people can pre-lock in their mortgage rates and pre-qual, but I think most people don't go that route. And so, yeah, now it's like, well, how many people that bought 12 months ago were expecting to get stress tested at 7.5% upon completion. And like all of a sudden you don't qualify for the closing. So yeah, there's I mean, it is what it is. I think it's going to be interesting to see, I think, in 2023.
Yeah, for sure.
All right. Well, you guys have already sort of answered my next question. In the new year, as this is the last roundup heading into it, do you think that's going to be the dominant story, stress in that pre-con sector? Or what else do you think we'll be seeing? John?
I mean, I think it's going to be a big story. Like I think Urban Nation, which does a lot of condo analysis, came out and said they're expecting about 18,000 completions in the first half of 2023, which is a huge number, right? So you're going to see very quickly how many people can close and what stress there is in the market. I think that's certainly one thing we're going to keep an eye on. The other is like in the resale market, it's tough to predict what it's going to be like. Like if it grinds down more, it's going to be because we see more listings, I think, and an increase in that. But it's hard to say from now what the resale market's going to be like. I think it's going to really depend on what the listing volume looks like.
And you don't have a good sense right now of whether those listings, which so far have been held back, whether they're going to start to come onto the market. And do you expect to see that?
I think we'll see more for sure. But again, the question is like, is it enough to drive prices lower in any meaningful way? Like, I think I agree with Steve. If prices go down next year, it's going to be a slower grind down, not a big dramatic one like we've seen. But again, I think the inventory levels are going to matter a little bit more in the new year.
Steve, 2023, what are you thinking?
Yeah, I don't know if it's like the biggest risk is like people not completing and closing on pre-sales. I think it's like, okay, you find a way to close because maybe you got enough equity there because you bought it well enough and the market obviously went up. But I think the question mark for me is really now you got to resell it because you're borrowing at 6% interest rates. Maybe you go to an alt lender because it's all you can qualify for. And so how long are you willing to sort of hold out? Like I said, I've been getting calls from people that say, hey, I'm losing $500 a month, $700 a month, $1,000 a month. They can make that work for 3 months, 6 months, 8 months. But like the longer this goes on, it's not a sustainable trajectory. So I think the question mark is how long do rates stay elevated for? I think even if they come back down into the 4% range, which is personally my view, I still think that's too high. So I think we're just going to see more stresses around, people with variable interest rate mortgages, investors with these. It's all the floating rate risk, is in my opinion, and obviously most investors tend to end up floating for, I think, the logical reasons, really. I mean, like, if you're an investor, you want the liquidity. So that's kind of what I'm looking at.
So not that any of this it can be seen as a good story, a news story, but if we start to see listings start to trickle up, especially in some of these sectors that you're talking about, both of you, pre-con and then the reassignment sales around newer condo listings, could there be an opportunity for those first-time home buyers who have saved a lot and have been waiting to maybe get into the market in the new year? Or should they still be cautious? Is there still more to come? Like, this is the big question. How long are we looking at a grind, which is going to level out, or should we be expecting even more potential dips and shocks?
John?
Yeah, I mean, certainly there's an opportunity to get in. I mean, the challenge is it's not any more affordable, because even though prices are down 25%, your rates are significantly higher. So in terms of like what it costs you, people can basically afford the same home that they could have afforded, 6 months ago. It's just that the price is down 25%, but their mortgage payment is their mortgage rate is a lot higher.
That's a great point.
I think that people buying, for the most part, that we see, are buying for the long term. They're not timing the bottom. They might look next year. They realize prices may dip a little bit more after they buy. But again, if you're buying for 7 plus 8 years, I mean, you're never going to time it perfectly. I mean, I think people are just, at least the clients we have, like, they need a home. They have a life change. They have a kid. They're moving, whatever it is. And this is what's motivating people. This idea that you can time the bottom perfectly. I don't think anyone thinks that. I think most people realize prices might dip further next year, but I think most of the clients we have are, generally optimistic over the long term. You know what I mean? So I think they're confident going forward.
I think we have maybe like similar clientele, which is like maybe because they're, educated, that we're trying to sort of remove them from as much market risk. But yeah, I definitely find that people that are transacting today are like people that have to and want to and need to transact. It's not like we're seeing a lot less investors. We're not seeing people like speculating, I'm going to do a fix and flip. And you know what I mean? It's people that need to make moves, and like, they're not going to delay their life for the next 2-3 years to figure out if they've hit bottom. Like, they're going to go out there, they're going to try to buy a house they want to be in for the next 10 years and try to negotiate a strong price and live in a home. So, I mean, like I said, I think that's kind of what we're seeing.
All right. Well, I guess the buzzword then for 2023 seems to be grind. It's not very exciting, but I'm going to blow through our interest rate corner very quickly because it's a regular feature, so we should be very good at it. Steve, at your live show, you polled the audience to raise their hands at what they thought the Bank of Canada might do and announce when they meet tomorrow in terms of where interest rates will go. I think most of your audience thought 50 points. I raised my hand for 25 points. I noticed that John sitting beside me was too cool to participate in this exercise at all. Interesting. Again, Dave LaRock on our Move Smartly blog, our guru on all things mortgage related, also thinks 50 points. Steve, I think you thought 50 as well?
No, I thought 25. I think it's 25 and done.
All right, you and me are 25. All right.
Yeah.
This is World Cup football time, so let's get that's locked in. John, where are you?
Yeah, I mean, that sounds about right to me. Again, I think they're starting to see the stress in the market, so I'd be surprised if they go 50 personally.
And let's get to a quick audience question. Steve, why don't you answer this one? This is from Raymond Wong. And he asks, if the Bank of Canada stops hiking rates and the US Fed Reserve keeps hiking rates, wouldn't inflation start to go back up again? And presumably he's talking about through the importation of those higher prices. So wouldn't there be pressure on the Bank of Canada to keep hiking rates in order to hit their target of 2 to 3% inflation?
Yeah, I mean, it's a good question. I think it's more like a matter of like how much the Canadian dollar weakens. I think the caveat is that the Fed is going to out rate hike everybody because I think it's, the US is the cleanest dirty shirt, right? So the reality is that every other central bank is slowly starting to pivot. So like if the Bank of Canada starts to kind of pivot and is not hiking rates, like Australia is not hiking rates. The ECB is, it's like, so it's all a relative game. And the reality is there was actually a survey out from a bunch of Bloomberg economists the other day that all said that they felt that the Fed had about 100 basis points of leeway. So the Fed could have interest rates 100 basis points higher than the Bank of Canada, and there would basically be no impact. Like the BOC Canada would be fine. And so again, that's Bloomberg economist. That's not me. But I think it's a relative game, is that the Fed is going to out-hike everybody. The Bank of Canada is not going to be able to keep pace one for one.
That's interesting. Some good numbers you showed there. All right. I hurried us along because I want to introduce a new corner called Apology Corner. We are going to turn to Australia, where the head of the Australian Central Bank, Philip Lowe, has apologized to Australians struggling with mortgages. And specifically, I believe he said something along the lines of, I'm certainly sorry. I'm not going to do my Australian accent. I do have a pretty good one, but that could be offensive. So I'm just going to read it out. I'm certainly sorry if people listen to what we have said and then acted on it and now regret what they've done. Now, I just want to point out, in case anybody thinks Australians, this is just how they are, they bluster, they say things, they apologize quickly. It once took over millions of people to get their prime minister to apologize for or say sorry about other political initiatives only a few decades ago. So this is not a common thing, but this has happened. I think it should be bigger news here in Canada. Steve, have you had dreams where you see Tiff Macklem just appearing to Canadians with a huge mea culpa around his neck, or what are you seeing? Jacob Marley type chains he's dragging around, Christmas Carol style?
I don't know. I mean, I think like I'm not the person that I believe, people should be crying boo-hoo and saying, hey, I made some poor investment decisions and, this guy should apologize. I mean, what's done is done. I just think it's been a series of policy blunders. Like, John, like we were on Yahoo Finance, like chatting about it every month, saying, the bank, like the housing market was out of control, prices were accelerating at 3, 4, 5% a month. And then these guys were still saying housing was transitory. It was a bit of pent up demand. Like we were, it was so plain as day that like, and now again, I think it's actually going the opposite now, which is like, I think housing is a leading indicator, and like, sales volumes at decade lows, prices falling, people's largest asset declining in value, investors and pre-sales, being crunched by all these rate hikes. And I just think like they're going to miss the pivot as well, which I think the damage is already done. Like, I just think like looking forward, like looking boots in the ground, seeing the stories that are happening. I think like, I just don't think we're going to be talking so much about inflation next year. And I just think I think there's a lot of economic pain personally to come.
And John, Steve's right. You also tweeted, I mean, we can show the wording up here from Tiff Macklem. There was a point at which there was a reassurance to Canadians that interest rates would remain, at a lower rate for a while to come. So go out and make your purchases. What do you think of all of this? Are we now seeing a deliberate policy to make consumers go out there and spend? And is there an element of the bankers, even the central bankers, trying to do their jobs on the backs of consumers, trying to rein in, first they were trying to hedge against, a recession brought on by COVID. So they, got us all excited. And now we're being crushed now that they have to rein everything in. So, are they using consumers basically to make their targets and bonuses?
Well, I think so. I mean, I think they definitely used home buyers. You know what I mean? I think the biggest mistake, at least from my perspective, what the central bank did, it's not cutting rates. I mean, they had to cut rates. Everyone in the world cut rates. There's nothing unique about that. But it was his messaging, right? Tiff Macklem's messaging, encouraging people to take on debt, telling people rates are going to be low for a long time. In 2021, when everyone was warning them about a housing bubble, he says, nothing to worry about. We need the growth we can get, which is basically saying we need you people to go out and take on debt and buy more homes, right? This is where they're using, sort of these millennials, these first-time buyers, to kind of stimulate the economy when they needed them. Well, now that they don't need them anymore, they're kind of throwing them under the bus, and prices have tanked like 30+% on a lot of suburban markets. Now, listen, we all make our own decisions. People are talking about how crazy the market was, like Steve said, but I do think rather than adding fuel to this housing bubble the way they did, they could have kind of calmed it down. Like they didn't need to see prices rising 30% per year, which is kind of what kind of brought us to where we are today. So I don't know. I think they completely blundered that goal, Steve.
Oh yeah, no, just to chime in here. Well, Ron Butler, he was a great follow on Twitter there. He was talking about today, and I was like, yeah, I remember that, but like, good for him for bringing it up. But like another thing is just like all like the regulators and stuff. It's just hilarious to watch, right? Like they're so like not in the trenches. They're so sort of just sitting in their chairs that they miss everything. And so, one of the ones that encouraged, so not only did Tiff Macklem encourage people to go variable mortgages, right? Like over 50% of like pandemic mortgage issuance was variable, because Tiff Macklem, number one, told everyone that he's never going to raise rates again, basically until 2023 or 2024. And number two was because the gap between variable and fixed rate was about 100 basis points. People were then getting stress tested at these lower, people opted to go variable because of the stress test. So like the stress test kind of it was kind of set up to basically encourage people to go with variable rate mortgages so they could borrow as much as they could. So I just think it's like all these policymakers, I just think while they're well-intentioned, I don't think they're forward thinking.
Yeah, I mean, and Steve's right. Like if you go back to last year, it's completely insane that if as a home buyer, I went with a fixed rate mortgage, I qualified to borrow less and spend less on a home than if I went variable, right? That's basically the way it worked out because of the stress test. And I think that's why so many people went variable. And I think it just is again, leading us to this vulnerable place where we are today. It's terrible. It's 100% correct.
Sure. I mean, there are people who say listening to anything anyone says is wrong. You make your own decisions, but that's not how the world of financial investing normally works. There are so many analysts, countless analysts employed to parse what the leaders of economies say and what leaders of companies state, as being their intentions. And these analysts scrutinize the documents backing these claims. So it seems like we're in a whole new world. We can't trust the due diligence of institutional and other investors who went hard into that, FTX digital currency mess. And now what? We can't trust what our central banks say either. So should I just invest in my friend's like latest, I have a can't fail restaurant chain idea, because at least I'll get like free food before I lose all my money? I really feel like, how is the average consumer supposed to think right now? Like, where should they be looking? What can they be doing? I'm gonna leave on that note as we just start to wrap up. John?
I mean, yeah, it is, listen, I think it is, you can't, it's easy to kind of blame Paul. The reality is no one kind of saw where we are today. Like, I don't think anyone predicted that rates would be where they are today. Even 12 months ago. So I don't know if it's like we can't trust everything. I think we have to take some personal responsibility too. Like, I'm not in the situation where I'm overly financially stressed and leverage. Part of this is because I think about my worst case scenario. I don't think rates are going to be at 1.5% for 5 years. And I don't plan around that. I plan around what is the worst case scenario and can I afford it? So yeah, to some extent, policymakers do need to think about how they're communicating. But there is some personal responsibility we have to take, especially like when we're making investment purchases. You can't call yourself a real estate investor and then cry about the market turning. Like, it doesn't work like that. It is what it is. You're making a risky investment. You are responsible for your actions. And if the market turns, that's part of it in investing, like in any market, right? So I think it's a mix of both for sure.
I think that's well said. I think let's be honest, let's call a spade a spade. I think this is like the cleanse that the real estate market in Canada desperately needed to begin with. It's unfortunate there's going to be a lot of casualties. I think this is a very astute learning lesson, I think, for a lot of real estate investors, because there's a difference between an investor and a speculator. And so, I think it's naive. I think this is just a subtle reminder that, like, you shouldn't hold on to every single word that the Bank of Canada says or Justin Trudeau says. You have to be able to think for yourself. And this is what I'm saying. You can't go out here and just blame Tiff Macklem and say, hey, he owes us an apology. I think I think reckless and naive comments. But again, I'm just looking forward and saying, okay, these guys are still coming out and saying, we're going to fight inflation. We're going to keep raising rates. And like I said, I think they're probably done. They should be done anyways, because forward thinking, forward looking. I think financial stress, there's the Bank of Canada comes out with a report that says 50% of all fixed payment variable mortgages that fit their trigger rate, 50%, 13% of all mortgages, plus the ones that are floating. So you've got like what, 25, 30% of basically of mortgage holders that are seeing significant increases in their monthly payments. I think that's going to really hit consumer spending, and it's going to hit the rest of the economy. And like I said, we've talked about it with the show. It takes a bit of time to filter through, right? There's people that are still making their payments. They're starting to cut elsewhere, but I think the rest of the economy is going to start to feel that in the new year.
All right. So the theme in 2023 seems to be like plan for the grind. Even if you see rates come down a bit, don't get all excited. Don't go all running out and doing the same thing. Does that sound fair?
Well, yeah, I just think the biggest thing is, like, people go, oh, who cares about real estate? It's just contained to real. It's not contained to real estate. Like, when people stop spending or spend less, they spend less in the economy. Like, one person's spending is another person's income. So you just have to think about it holistically. I'm not saying this as like, a real estate bull saying we should instantly start cutting interest rates. I'm just saying that people should start to prepare or brace for, I think, spillover effects. And again, maybe that's what you're hoping for, maybe it's not, but I just think it's naive to think that this is contained to Toronto pre-sale investors and they're the only ones that are going to be impacted.
Yeah, I mean,
right, John, the last word to you. You have a last
100%.
chance.
Yeah, and I think Steve's 100%
my New
right.
Year's resolution.
What was that?
You have a last chance to influence my New Year's resolution.
Okay.
What are the themes I need to be taking in?
I mean, I agree with Steve. It's going to have spillover effects. And quite frankly, this is why we're seeing a lot of the banks and mortgage insurers allowing now homeowners to extend their amortizations to 40 years. And they're doing that because people are getting these massive payment increases when they're renewing their mortgage. And people think the banks and the regulators doing this to save the housing market. They're not, because as Steve said, if your payment goes from $2,500 a month to $3,500 a month, that's $1,000 a month less you have to spend, right? And it can have massive ripple effects on the economy. And I think, yeah, if you have a mortgage renewal coming up, you need to start planning and thinking about, how to manage those increases, and maybe talking to your bank about lowering those payments for the short term, because you're going to get hit with the massive shock. And I think, as Steve said, those are the effects that we're gonna, even with longer amortizations, people are still going to have higher payments. It doesn't matter. And I think it's going to take some time for that to filter through.
All right. Well, plan for the grind. Not the cheeriest of slogans for 2023, but it has been a real pleasure to talk to both of you all year, and hope to continue to have great conversations in the new year. And I hope you guys have, a chance to rest a bit and enjoy the holidays with your friends and family as well.
Sounds great.
Thanks for having us on. It's going to be a wild 2023. I think there's going to be so much more to talk about. So hopefully everybody, tunes in, and hopefully you get some value out of this. And yeah, it's been great.
I agree.
Yes, keep the questions coming. You can find us on Twitter, Move Smartly. You can find us on our YouTube channels. John and Steve are pretty active. You can see this in our notes as well. And just keep the questions coming. And I guess plan safely, but hang on for the ride.
Sounds great.
We'll see you in the new year.